Hey everybody. Hey everybody. This is Tarek. I'm a professor at Rice University and just had a interesting morning. I wanted to talk to you guys a little bit about tender offers. So there's a company I've been following for a number of years called Diana Shipping. It's an interesting company. It's a dry bulk shipping company. What they do is they transport grains, coal from one of the big buyers of commodities is China, right? These grains come from the United States or Brazil, and coal comes from Australia and other places. But anyway, this company, Diana Shipping, which has a trading symbol of DSX, has been depressed. The stock price has been depressed ever since the coronavirus pandemic started in March, and but lately, shipping rates have been doing pretty well, and they're kind of high relative to their seasonality. And overall, the market, as you guys know, has recovered quite tremendously, and the stock has been quite lackluster. But on December 15th, Diana Shipping announced that they were willing to buy back 6 million of their shares, which is about 7% of their float. And that's something that's typical. If management think that their stock price is undervalued, they'll go out and buy. And the reason why that's value creating, right, is that if they think if the stock price really is higher, some number X, right, and that exceeds the stock price that they're buying at, that exceeds the price that they're buying at, which in this case is $2 a share. So if X is $3 a share and they're buying at $2 a share, that $1 a share times the number of shares they're buying, which would be $6 million in this case, is new value created for shareholders, and it's not taxed at the corporate level, which is an advantage over making a new project that creates more revenues and taxable income. So anyway, December 15th, this company announces that they're going to do a tender offer at $2 a share. And what caught my attention a little bit was that the price up until the date where the tender offer was going to complete, the stock price jumped from below $2 to now at $2.35 of late. And who's going to sell their stock to the company at $2 a share if the stock price is $2.35 a share? And so I was wondering what was going to happen. And what did happen is that yesterday, January 13th, the company upped the purchase price. So instead of buying it at $2 a share, they indicated they're willing to buy it at $2.50 a share. And they kept the shares that they're going to buy at 6 million. So that's a strong sign that the management think that the real price, the X, right, is higher than even 250. What's interesting is that this morning when I checked on the company, the stock was down 10% at something like $2.15. And that is interesting because if you buy today, which is January 14th, and you commit to selling back to the firm at $2.50, that delta between 215 and 250 is a 16% return earned over 13 days. And so if you annualize that return, you get something enormous, like 6,673% annualized returns. Of course, the market is going to figure this out, and people are going to buy the stock, right, and then tender those shares to the company. And they're going to do that. And so I think already, as I check now, it's already back to 227. It's still down 5%, and 227 to 250 is still a very good return in 13 days. And so what's probably going to happen is that there's going to be more investors tendering their shares, i.e. there's going to be more than 6 million shares tendered. And ultimately the company's going to buy a pro rata portion of each investor's shares. Each of the investors tendering their shares, the company will buy a pro rata portion. So that'll reduce the potential return, but it's still, you have one sign from management that the price is probably low, and then you have this opportunity to make a decent return in a short amount of time, even if it's just a pro rata portion of your shares. So I'll keep following this. I may chat about it some more with you guys, but it's an example of tender offer by a company who thinks that their stock is undervalued. And one of the points I wanted to make was if you the way a repurchase adds value is if the price is really X and that's above the purchase price, in this case 2, right? You take the difference, X minus 2, and multiply it by the shares repurchased. That's the value created for all continuing shareholders. And that's tax-free at the corporate level. And then there's this idea that if it's a really good deal, our investors are all going to sell their shares back to the firm, and there will be a pro rata allocation, which will reduce this potential return. But it's nice you have two signals. One, you have one opportunity to make that return by selling to the shareholders, selling to the firm in a pro rata fashion. But you also have this signal from management that they think their firm is undervalued. But anyway, I'm happy to discuss. Leave some comments below if you're interested in learning more. Thank you.